I'm Matteo Muscat from Bilbel Capital. I would like to welcome you to another episode of our monthly podcast. I'm here with Gabriel, and today we'll be discussing the topic of decision making. So, um, to start off with a definition, how do we define a good decision in investing, Gabriel?
I'm not sure, but what I start with is with a good explanation. So basically, what I am looking for is a way I can explain what is happening by attaching the thing that has created what I am seeing and the thing I am seeing. And when I have a good explanation, then a good decision can start from there. So once I have my first explanation, my goal from there is to improve on it. So basically, when a good explanation is there, there's a level of truth inside it, and there's a level of truth because there's a level of causality. So if one thing partially causes another, then there is some element of truth in it, but in totality, it is always false. So what I mean is that nothing or very few things directly cause other things, especially in a system that is unbounded like life, in which investing is inside of it. So when I start with a good explanation, my goal is to correct the explanation as fast as possible and to improve on it and to keep doing so until I cannot keep doing it. So that is where I see it. Now, what really matters when correcting errors is the speed of doing it and how much error you correct. But realistically, the thing I realized that I can control the most is the speed at which I do it. Because realistically, I never know how much error I will correct. But what I can do is I can control how fast I work on correcting it.
Okay. And do you think that the outcome of a decision should be used to judge whether a decision was good? Can you have a situation where the outcome is possibly wrong, but the decision itself was still a good one at the time? Or is that something which is not possible?
It is possible, especially with investing. So realistically, you never quite know what went right and what went wrong. Normally, you can, if I really think hard, I can know roughly what went right and what went wrong. But there could be things that I do not know that went in my favor, or things that I do not know that went outside my favor, that couldn't have been predicted. So the way I see it is, I ask myself, were there things in the past that could have been predicted that I did not predict? And if there were, then there are things that I could have improved. But if there were things which I knew could happen, but I could not predict whether they would or wouldn't, and were things that there was no chance in which I could know if it would happen, and it actually happened, then that might be useful to look into, but it it cannot really help you much for future decisions.
Okay. Do you have a specific example in mind, perhaps, of a decision which was a good one, but potentially led to an outcome which was not as good as you thought it was going to be, or possibly the other way around, a decision which, with hindsight, wasn't correct, but which potentially led to a positive outcome?
Well, I could give an example of today, but we
Okay.
don't yet know if the decision was right. So, for,
Okay.
for example, with Interlego, I think Intellego at, let's say, 120 SEK was very cheap. But after the short attacks on Intellego, the stock went down up to 65 at a point. So that could not have been predicted, really. What could have been looked into was the business and the future of the business, which is important. And but the short attack couldn't have been predicted. So that is something that is likely to arise in every single investment in different ways in which we do not know. But over a long enough time period, the market will correct the errors in over time. And what I would think is the case is that Intellego will reach closer value to what its real value is. So that is something that I would take into consideration, but for future investments, I cannot model a short attack to come or not come because there is no way I could put it in a thesis to help me make a better decision.
Okay. And with regards to the decision-making process, what roles do data and intuition play in the decision-making process?
So data is very important. In in reality, the only thing that matters is the data. But the real edge one gets in investing is to predict the data before the data happens. And for that, one must need an explanation of why the data is happening. Or else, in some cases, for example, with quant funds or funds that create statistical models, sometimes they do not need to explain why things happen, but they need a very large sample size to test that something happens when done many times. But in my case, since I am hitting only one stock at a time, I cannot rely on statistical models. I can only rely on the best explanation of what's happening. So data is extremely important. It is what I start with because if I do not have any information about anything, data helps me create questions in my mind to start understanding what's happening. But once I have the data, then my thought process goes in the chain of why is this data here and what caused it. And if I know what caused it, then maybe I can know roughly what will cause the data to change in the future. Now,
Okay.
intuition, I think that's a very hard one. I think over time, intuition gets better if one really focuses on understanding it. So the way I see intuition is, it is a collection of explanations you have in your head, but you have not yet translated into language. So there might be many many data points or networks in your mind about why things happen. You've never really talked about them or thought about talking about them, so they have never been translated into an idea in useful form, but it is useful to you. I think that is very valuable, but it can be very misleading if we mistake intuition for a feeling, which is not useful at all in that case.
Yes, definitely. In fact, what I was going to ask you next is where do you see the limitations of data and intuition in decision making?
I think one can do very, very well without any intuition, just by relying on data and explaining what caused the data. I think that is totally possible. Over time, the thing is that translating your ideas into language requires effort, and to translate everything would be impossible. So eventually, over time, the amount of knowledge you have in your head, which is not translated, grows, which means that your intuition also grows. Now, if you focus on the truth, your intuition gets better. And if you focus on things that are not the truth, your intuition gets worse. In terms of limitations, it really depends on a lot of things, honestly. But if I think the limitations can be easily seen if you really care about seeing those limitations.
Okay. And moving on now, focusing a bit more on the biases in decision making. Um, how do you reduce biases in the investment choices, which you have made perhaps some practical examples which you have used?
Well, the bias changes over time. So the most amount of bias I have is in the beginning because I have the least amount of information and the least amount of knowledge about what I am looking at. And as I look to correct what what I'm understanding, my bias goes down. I would say the most useful thing to see through biases is to have awareness of the bias happening in real time. So what I usually realize is that when I see information and my mind reacts immediately to that information without me having processed why it happens, that is usually where a bias starts. So, for example, I would see a company in, let's say, China, and immediately my mind says, oh my God, this is China. You must be careful because there is something you're missing, for example. And that bias might lead me to not look at that investment and look at another one. Now, in that specific case, it might not be very harmful, but the most amount of harm in a bias would be if you actually make an investment because of the bias, not if you remove an investment because of a bias. Because realistically, the mistake of not investing is the opportunity cost, but the mistake of investing, well,
Is loss of capital
is
potentially?
also opportunity cost, but also possibly loss of capital. Exactly.
Mm,
Exactly.
okay. And now, have you ever used any particular systems or checks, however, to spot or correct biases?
Yes, I I am working on creating more of them. I think they are very useful because I tend to forget quite a lot. So even though I derive a lot of things by what I think are the most fundamental things, deriving them takes time and effort. And if you need to derive 500 things, that will take a long time, and sometimes it's not even feasible. So over time, creating systems that are fundamentally very strong and that also win you back some time, I think are very useful. I would say one of them is looking at similar companies. So let's say I find a company that I think is cheap. If I look at all the similar companies and I realize that all of them are cheap, then that means that I am likely missing something about the whole industry. Because if I thought one is cheap, and if I had to look at another one, I would have thought that it was also cheap, and all of them are cheap. That means that the
That's not
market
cheap anymore,
thinks,
Volchi.
well, they might all be cheap. That could be. Or
Okay.
else I might be missing something about the whole industry, which is affecting all of them.
Okay, I understand. Okay.
Now, in the case where there's a company that's cheap and all the similar companies are expensive, then that means that if I'm missing something, I'm likely only missing it in that company, not in the industry. So I
Okay.
could see many ways in which I can create checks like these, such as that. I would say probably another use case would be seeing the same business model in the past, let's say 30 years ago, and seeing what changed and what is different today versus then. Or else uh, a company that is basically the same business model exactly, just in another country. to see
Mhm.
what is different. Yeah,
Okay. Could there be external factors in those countries, though, then which could have could influence the impact?
100%. Yes. But I think it's probably still useful because when I do that, I figure out, okay, so even though I'm comparing them, this one is cheaper than the other because there are these external factors that are creating it.
Okay.
But that would help me create a better understanding of the whole thing in general. Yes.
Okay. I understand. Okay. And now, with regards to conviction now, um, in uncertain situations, how do you build conviction?
So I used to think that conviction is important, but conviction is not needed. So
Okay.
what is really needed is really knowing what causes something to happen. And if I know what causes something to happen, then if I am very convinced or not convinced, if what I have in front of me is an explanation of this causes this, and that is what is happening, then my conviction will not change that causal effect. So conviction is usually a mixture of a bias or biases and a good thesis. But I can just remove the biases and remain with searching for a good thesis.
Okay. And now, there are obviously, we touched upon this point already, situations where you decide to act and other situations where you decide not to act. When it comes to not acting, how do you decide when to not act?
I think that's a very hard question, to be honest. I'd have to think a bit about that. I would say when when you have a when I have a good thesis and I am not buying because let's say the stock is going up and I'm not being aggressive, that is a time in which not acting could be very costly. But when I have a good feeling about a company, but not yet a good thesis, that is a good time to not act.
To not act.
So I would say the difference between acting and not acting is if you have a good thesis already, then the cost of not acting is high. So it is likely that not acting is a mistake. And if I don't have a good thesis, but I just have a good feeling and there is momentum in a stock, for example, then that is a very good indicator that it is the right time to not act.
Okay. Do you feel that it can be psychologically difficult to not act when perhaps everyone is acting?
Yes, to be fair, for myself, not really. I don't really feel it, but I do understand that it is very true. Yes, yes. I mean, it uh, we talk a lot about being contrarian or being independent. To be fair, being contrarian in itself is not a good trait. It is it's not a bad trait, but it's not a good trait. So the best trait is wanting to understand what's happening or wanting to find the truth. Now, if you find the truth and it happens to be contrarian, then people would
So
call you
be it.
contrarian. But if you find the truth and the market agrees with you, then you're not contrarian, but you've also found the truth, which is fine. So yes, I mean the thing is that emotions are not very important day to day in investing, but in the times where it is most critical to make a good decision, it's normally also the time in which your emotions run the highest. Because basically, the best investment is one in which perceived risk is extremely high and the real risk is very low. And if perceived risk is very high, then everyone around you will tell you that the risk is very high. And that is also the time in which emotions will arise and say, listen, are you sure you're the only person on earth thinking that you're right? And that is also the time where it is most beneficial to be rational and to make the good decision. So the importance
Okay.
of emotions in many ways is proportional to the actual importance of the decision.
Could you give a specific example where this reasoning was needed most, perhaps?
I mean, the most, well, the most recent example is Interlego.
Yeah, I was gonna say Interlego. In fact, it happened many times, both in the beginning as well as now, and it seems to keep on happening with Interlego.
Yes. So the time, the best time to buy Interlego was obviously, this is obvious, obviously at the lowest price. Now, at the lowest price, it is also the case that since it is at the lowest price, there are the most aggressive sellers at the time. And when there are the most aggressive sellers, there is the worst sentiment around the stock at that same time as well. And when there's the worst sentiment around the stock, that is when your mind reacts the most to that bad sentiment, which is why most people sell at the same time. Because one person sells, it goes down, another person sells, it goes down, and the sentiment spreads to different people. But that is exactly the time when being rational becomes the number one priority.
Okay. Now, um, what lessons can one learn from decisions that went wrong?
I think that's tough, honestly. Like, I like to say that I learned from my mistakes, but realistically, when I make a mistake, first of all, the feedback loop of knowing if it was a mistake or not is long. So I might have to wait years to know if I made a mistake. And then again, after years, I might have forgotten the small details as to why I made the investment back then, which would make it even worse of a judgment as to me trying to trace what I did wrongly. And also things that I might have not considered that went out of my favor, which make me learn the wrong lessons. So I think the most common thing that I do, and I think that this must happen to humans because of the long feedback loop and short-term memory, is that we learn the wrong lessons all the time. Because when we make a decision, we only know if the stock went up or down after, let's say, months or years. And even then, we don't know exactly why the stock went up or down. But what I would say is that learning doesn't need to happen when there is a failure. Learning can happen continuously, both during a good time or a bad time when the portfolio is going down or the portfolio is going up, or when the portfolio is not doing anything. And then as a consequence, there would also be learning from failures, but learning from failures, I think is only a small subset of learning. I think learning can happen continuously and it does not need to
Be
now
tied
exactly
to
now
successes or failures?
as a exactly. So I do understand that people are more motivated to learn what they did wrong after a mistake because people people do things when they're motivated to do it. Now that happens when they're either inspired to do it or when they are painful, when they feel pain. And that means that when one goes through a failure, he will likely feel pain. And when he feels pain, he will be motivated to learn what he did wrongly. But the ideal scenario, which of course is well, I don't learn continuously all the time. That would be great, but that's not the case. The ideal would be to actually just learn all the time and not when I am motivated to do it or when I am inspired.
Okay. Now, as a last question to tie up this podcast, in your opinion, what is the most important element in the decision-making process in investing? It could be anything, just your opinion on the most important element or the
I
most
think
important step.
I think it's honestly being innocent. So what I mean is that by innocent I mean being ready to find the truth regardless of what it looks like. So sometimes I realize that something works a certain way and it feels strange that it works a certain way. So I would have a bias to reject it. But if it works a certain way, it works a certain way. And my opinion will not change that. So I think the most important thing would be that in public markets, we receive feedback every day from the stocks we own. And the feedback loop is very long, which means that we cannot learn from really from the feedback loop. We must learn from an internal feedback loop, which we create ourselves, of actually trying to learn what's happening and what's causing things. So I think being innocent in the sense of tr trying to independently think as to why something is happening without accepting what is being heard about in consensus is probably the most important thing. That is what I would say it is. Because
Okay.
sometimes an investment is very hard to understand, but there are some cases where actually an investment is not hard to understand, but the biases are so strong that they still make someone not make an investment. And when one is innocent in really understanding what's happening, those biases tend to be seen through easier.
Okay. That that was honestly all which I had to ask for today. Thank you so much, and thank you to all those who have watched today's episode. I would like to invite you all to like our video, subscribe to our YouTube channel, and to follow us on all our social media platforms. If you have any questions or any particular topic which you would like us to discuss, um, you could either comment on the video itself or contact us on X or on LinkedIn or via email, or you could contact me directly as well on X or LinkedIn. And that was all for today. So thank you all and wish you a great day ahead. Thank you very much.
Thank you, guys.